Hi everyone. We are now going to review problem 719 on page 321. During Heaton Company's first 2 years of operations, it reported absorption costing net operating income as follows. So their sales for year one were $1 million, cost of goods sold for per unit, everything, $720,000, gross margin $280,000. They're selling and administrative $2 per unit variable. The other $130,000 of the selling and administrative costs are fixed. They don't change. They're subtracted from gross margin to get net operating income. And then you could see year two there as well. The next page, the company's $18 unit product cost is determined as follows. Direct materials are 4, direct labor 7, variable manufacturing overhead is $1, fixed manufacturing overhead per unit is 6. So the total absorption costing unit product cost is $18. 40% of the fixed manufacturing overhead consists of wages and salaries. The remainder is depreciation on product equipments and buildings. Production and cost data for the first 2 years of operations are, and then you could see those amounts. Using variable costing, now remember, this is presented as absorption costing, but using variable costing, what is the unit product cost for both years? So we're focused on the variable cost of the unit. So that would be your direct labor, your direct materials, because those are variable, and then the variable part of manufacturing overhead. So we wouldn't include the fixed part of manufacturing overhead. So the variable cost per unit would be $12. Now in part 2, it says, well, now that you know the variable cost per unit, what is the variable costing net operating income in year 1 and year 2? Well, they sell the units for $25 each. That's given to you on page 321. They sold $45,000 in year 1, or I'm sorry, $40,000 in year 1. So $40,000 times $25 would give us the $1 million. For year 2, it would be $50,000 times $25, and we would get $1,250,000. Now, we're doing a different type of approach. Here, we want to subtract all of our variable costs, none of our fixed costs, to get to our contribution margin. So what variable costs do we have? Well, we have the ones that make up our product costs, direct materials, direct labor, and the variable portion of overhead, $12 per unit. So cost of goods sold would be the $12 per unit times the number sold, 40,000 for the first year. And then $12 times the number sold, 50,000 for the second year. Also, we want to subtract the portion of selling and administrative that is variable, because you collect all the variable costs first and subtract those. $2 per unit times the number of units sold, 40,000. Where do I get the $2? Again, it was given to us on the bottom of page 321. It tells us the portion of the fixed cost, or I'm sorry, the selling and administrative costs that are fixed and the part that are variable. We also would do that for the second year, taking the number of units sold times the $2 per unit variable selling and administrative expense. Subtract those two from the sales to get your contribution margin for each year. So the total variable costs for year 1 are $560,000. Subtract that from the sales of $1 million. Contribution margin $440,000. Go through the same process for year 2. Total variable expenses are $700,000. Subtract that from the sales to get a contribution margin of $550,000. Now, after we do that, now we can subtract the fixed expenses. So the fixed manufacturing overhead is given $270,000 for each year. And that's at the top of page 322. The fixed selling and administrative are given on page 321. They're $130,000 for each year. They don't change as sales change. So the total fixed expenses are $400,000 for each year. We would then subtract those fixed expenses from the contribution margin each year to get our net operating income. So a different approach to an income statement. The variable costing income statement. Now, the third part says reconcile that absorption costing income statement that was presented on page 321 to the variable costing income statement you just did. So let's take a look. To do that, the first thing we want to determine is the units of inventory. So we begin year 1 with no beginning inventory. We produced 45,000, we sold 40 of them. So there's 5,000 left at the end of year 1. They're the beginning inventory for year 2. During year 2, produced 45,000. This is given on page 322. Of that, 50,000 were sold, or all of them. So there's none left at the end of year 2. So what does that mean for year 1? The fixed manufacturing overhead in ending inventory would be 5,000 units times $6 per unit. Okay, so how much fixed manufacturing overhead is in the absorption? Remember, the absorption includes fixed overhead and variable. So we're saying, well, how much was fixed? 5,000 units that are left in ending inventory times $6 per unit. Was there anything from last year? No. Going into year 2, how much is in ending inventory? 0. How much fixed overhead was there in beginning inventory from last year? 30,000. So that means manufacturing overhead deferred was 30,000 in year 1, and then it was released in year 2. Variable costing net operating income is our next starting point. So what kind of net operating income did you determine using variable overhead? I'm sorry, variable costing, 40,000. How much fixed manufacturing overhead was deferred? 30,000. So 40,000 plus 30,000, if you go to the page 321, okay, that will tell you how much your absorption costing net operating income is. And it does, it agrees. The next year, your variable costing net operating income, you determined to be 150,000. Now subtract or deduct the fixed manufacturing overhead cost released from inventory under absorption costing, 30,000. And that will reconcile your variable costing income, net operating income, to absorption costing, net operating income, to prove that you are correct with how you determined it. Okay, so a different approach to see what is our contribution margin when we just subtract the variable expenses from our sales. Because we need to make sure that we sell enough to cover our fixed. So we alter the income statement and present it a little differently so that we can make decisions and know where we stand when it comes to individual unit sales. So please post any kind of questions you may have to the discussion board.